Let's talk about two different approaches to investing, illustrated by our friends Sarah and Tom. These two friends are both ready to invest, but they have very different ideas about how to do it. Sarah craves stability and a predictable income stream from her investments. So, she buys dividend stocks. These are shares in established, profitable companies. Companies that pay her a share of their profits. It's like a gumball machine, dropping coins into her hand every quarter. That's a dividend, a regular payment just for owning the stock. It's steady, predictable, and reliable. Tom? He's chasing the future, always looking for the next big thing. He buys growth stocks, companies that are expected to increase in value significantly. These are companies that reinvest every dollar to get bigger, faster. No cash payouts for Tom. He's betting his shares will skyrocket in value someday. He's aiming for substantial capital appreciation. Sarah's portfolio grows quietly, fueled by consistent dividend payments and strategic reinvestment. She reinvests her dividends, compounding her wealth over time. It's not flashy, but it's dependable. Tom's ride is wild, full of ups and downs. Some days his stocks soar. Other days they crash. No dividends to cushion the blow, just the hope of big gains. Sarah's approach is slow and steady, building wealth with discipline. Tom's is high risk, high reward, chasing the next big thing. Both strategies have their place and both can be successful depending on your goals and risk tolerance. But the experience is very different. Sarah gets paid to wait. Tom waits for the big payoff. One values consistency, the other, potential. Which path would you choose? Investing isn't one size fits all. It's about knowing yourself and your goals. Are you a Sarah or a Tom? The market has room for both. The key is understanding the trade-offs. Steady income or big growth? What matters more to you? That's the real question. Your answer shapes your investing journey. Choose wisely and invest in what aligns with your personal financial philosophy. Dividend stocks are your ticket, a pathway to potentially consistent returns. To steady income, a reliable stream of cash flowing directly to you. Own a piece of a company, become a shareholder, and participate in its success. And in return, get a share of its profits. Simple as that. It's a direct reward for your investment. Think Coca-Cola, a global brand known for its consistent performance. Or Procter & Gamble, household names that have stood the test of time. Mature, cash-rich, and reliable. These are the hallmarks of dividend-paying giants. Dividends put real money, tangible cash in your pocket, providing a tangible return on your investment. Even when markets are rough, dividends can provide a buffer against volatility. It's a psychological cushion, a sense of security knowing you're still earning. Proof you own a real business, not just an abstract investment. Not just a ticker, but a share in a thriving enterprise. The trade-off? What are you giving up for this stability? These companies rarely double overnight. Rapid growth isn't usually their game. You get stability, a foundation for your portfolio, but less explosive growth. The returns are generally more predictable. And remember, a crucial point to keep in mind. Dividends aren't guaranteed. Companies can change their policies. If a company cuts its payout due to financial difficulties, your income and stock value, both are vulnerable, can drop fast. The impact can be significant. That's why research matters. Thorough investigation is key. Look for companies with a strong history, a proven track record of success, of paying and raising dividends. Consistent growth is a positive sign. The best? What are the gold standard in dividend investing? Dividend aristocrats, the elite of dividend stocks, firms with decades of consistent payouts, demonstrating long-term commitment. So if you want income, a steady stream of passive earnings, and peace of mind, knowing your investments are providing for you, dividend stocks deliver. They can be a cornerstone of a successful portfolio. But always check, always do your homework. The company's health before you buy. Ensure they are financially sound. Stability is great, a desirable quality in any investment, but nothing is risk-free. All investments carry some level of uncertainty. Choose wisely, make informed decisions, and get paid to wait. Let your investments work for you. Growth stocks are for the bold, the ones who aren't afraid to take calculated risks in pursuit of substantial returns. Think early Amazon or Tesla. These companies often offer no dividends, just reinvestment and ambition. You're betting on the company's future, on its potential to disrupt and dominate its market, hoping your investment multiplies exponentially. The reward? Potentially massive gains, the kind that can transform your portfolio. The risk? Wild price swings and no income if things go south. Growth stocks suit those with time and strong stomachs. If you can handle volatility and wait years for results, this path could pay off big. It's not for everyone, but the upside can be life-changing. Are you ready to shoot for the moon? It's a thrilling ride, but remember to buckle up. So, which is right for you, dividends or growth? It depends on your goals, risk tolerance, and timeline. Need steady income? Go for dividends. Chasing big gains? Try growth. Most investors blend both for balance. Diversification is key. Write down your goals, know your comfort with risk, and start small. The best portfolio is one you can stick with, through ups and downs. Don't overthink it. Just get started and learn as you go. The market rewards those who stay in the game. Booyah!